What should you do though before the end of the year? We do think you should take action, and we do think you should be nervous. Right now, the S&P 500 is largely concentrated into the top 10 stocks. That's dangerous and potentially scary. It's really important to start thinking more sophisticated. Think like an endowment. Think like a family office. That is a very large organization or family that has tons of money and hires their own suite of advisors. Pensions, sovereign wealth funds, high net worth individual investors, and even financial professionals, and even down to retail investors. When you look at these, they have a much higher allocation to alternative investments. Endowments have 40 to 60% of their money in private or alternative investments. Family offices, 30 to 45%, so on and so forth. So why do they allocate their money differently than the retail investor, which is not even on this chart, really, if you think about retail investors and or even financial professionals? Massive differences in how they allocate their money. Well, let's look at why. There's a lot on here, including important disclosures. But if you look at the main sections where my cursor's moving, and I think you can see my cursor, you may not be able to, but top left quadrant, average annual return. And you can see a 60-40 portfolio. That is 60% stocks, 40% bonds. That portfolio, average annual return over the time period shown, 8.5% return. But if you had 15% alternatives, private investments, private equity, private debt, infrastructure, real estate, you're able to garner an extra bit, a little bit more return. If you add 25% alts, even more alts, you garner even more return. But the kicker here is when you go across to the top right quadrant, you see that by adding those alternatives, the 15% in the orange and the 25% in the gray, you also are lowering your overall volatility or risk as measured by a standard deviation. The bottom two quadrants tell you the same story, risk return ratio, and also your drawdown is a big 1 year downside potential. So by adding these alternatives, like these groups of people, endowments, family offices, pensions, and sovereign wealth, and high net worth individuals, you end up getting better risk-adjusted returns. Here's another look at the same data. This is an efficient frontier showing you how do you create the highest, top left would be the highest return with the lowest risk. And so in the top left, how do you move your portfolio up towards that area of this graph? And you do that by adding in the alternative allocations. Yeah. Getting less volatility and more potential return. Pretty special way to, almost like a free lunch. You can know that if you do this in the right way, there's a high probability of good outcomes. Last but not least, I want to show a couple specific endowments. This is publicly available information, hence we were able to show it via the source down below. Harvard and Yale, compared to a perfectly invested 60-40 portfolio, stocks and bonds, no behavioral blunders, the returns are demonstrably different. You can see that Yale had 10.49, while Harvard had 8.8, and a 60-40 portfolio had 6.42% returns. This compounded over a bunch of years is going to have a massive impact on you and your financial picture. So what our story is, as you look to the end of the year and you think about this very good question, is the markets are at all-time highs and they've been at highs for a while. This has been an unbelievable bull market. I've been investing and helping clients save and prepare for their wealth for over 27 years. Save their wealth and prepare for retirement and their financial futures. And this is one of the most extended, I almost say egregious, but it's a great time to ask the question, am I invested correctly? Do I have an intelligently constructed portfolio? Am I investing like an endowment, an institution? Am I doing the best I can do for myself? When we talk to prospective clients, at least 9 out of 10 times, their portfolios are not optimized.